Welcome to TMS Insights. It's the end of February. In fact, Leap Day, Ben, happens only once every 4 years, but bull markets happen pretty regularly. And we've been flying since we brought you the last update of reporting season, and now we're getting into the last of those reports. But also some things that have been going on in the market, because it's actually been a really very busy market this month, and there's been quite a lot of corporate activity, some price changes. So we're seeing volume's pretty high, and there's certainly some things going on, Ben. But let's get into some results for everybody and let's talk about some good, some bad, and all that. WiseTech going pretty well.
WiseTech was good. So that I think the big surprise there was back in August at the last result, they surprised the market by reducing down their margin guidance. And in this result, they exceeded 50% EBIT margins in this, and actually guided that that's going to accelerate. So it's sort of wrong-footed the market, but this company just continues to dominate its space. It's signing up new customers. It's becoming the entrenched position, and I still think probably one of the best growth stocks on our market.
And having had the Altium takeover bid during the month, let's maybe talk about Xero, which is obviously another meaningful company in this similar Aussie tech space. And Xero obviously has had a pretty interesting year altogether.
It has. Xero, there's obviously been the compression that happened with bond yields. I think that's now in the rearview mirror. I think the big thing with Xero has been the new CEO coming in and dialing down the amount of money that they're reinvesting. So they've had an investor day this morning, actually, and what they've come out with, which I think is quite major news, is that they have said that we believe we'll move to the rule of 40. Now, the rule of 40 in technology stocks is seen as the gold standard in terms of getting a business to be profitable, but growing very rapidly profitable. And there are very few companies globally that could ever meet this rule of 40. It's your revenue growth plus your free cash flow margins is greater than 40%, and that's a very hard.
Often going to be a tech style company or a SaaS company.
Well, you need to be a capital light business to do it. But she's definitely become much more targeted in the areas she wants to grow into, and I think Xero looks good. But I guess the thing with Altium, Jez, is that $9 billion is going to come out, and it's going to stay.
Xero,
it's going to stay in that space.
It's going to stay somewhere in that space. So there's going to be some beneficiaries. So staying with that theme a little bit, talking about Block FinTech. So obviously global company listed here as well. It's done pretty well of late.
It has. So most people might know this as the old Afterpay, but of course it's a completely different business. This is Jack Dorsey's company, and they have had another very large upgrade. We saw a 20% kick on the back of it. Afterpay is actually going well within this business. It grew 25% in terms of the transactions it processed. But the best way to think about Block is they want to completely disrupt Main Street in terms of banking. So they want all the kids and probably our age to be using the Cash App. And they now have about 66 million Americans who bank on the Cash App. And they continue to surprise with the updates they're giving. But they're also, like a lot of tech stocks that we've seen in America, they've been ruthless on their cost base in the last couple of years. And that's meant that they're becoming profitable a lot quicker than we expected.
Yeah, absolutely. Woolworths changing streams a bit here. It's been a busy year. They wrote down, they've downgraded outlook, they've lost a CEO, and their share prices declined. How does it look valuation-wise now to you?
It looks good. I think this one, in the blue chips where a lot of stocks have run very hard, this is one that we could look at.
There aren't a lot of value buys in the top end.
No.
And so the 20x dividend this week.
Trading on 19, 20 times.
4.5% grossed up div yield.
And a return on equity over 30%.
30%, which is again in that top bracket of stocks.
It's unusual. There are very few businesses can do that. And Woolworths is actually quite a capital intensive business.
Parts of it, certainly are. And really interesting one there. Just another stock in a totally different space again, but it might be value because it's come down in the reporting season. IDP Education won't be known by everybody.
No. So quick background, because we have been looking at this one, is spun out of Seek some years ago. It was put together by a consortium of the world's largest universities and colleges to provide a tech platform that they could all test students and on. And it's completely, since it started its listed life, it's morphed into other areas. The big area for it these days is doing all the visa testing that needs to be done. If you've got a kid that wants to go and study in Canada or America, there's certain visa requirements that they have to meet, and that's done on the IELTS platform. And that's
IELTS.
Yep. The stock's been weak because there's been this crackdown on the number of visas being issued in the West because of political issues around cost of living pressures and all that sort of stuff. So their result, I thought, was really impressive because similar to Seek we were speaking about in the last video, what's in their control, they're doing very well. The volumes are out of their control, but will change at some point. So I reckon it looks interesting.
Another sector of the market, totally different again, that not necessarily in the reporting season, but just price-wise. Some of these infrastructure stocks, Ben.
Yeah.
I mean, we know it's very sensitive to bond yields. Just got quite settled lately, haven't they? The whole yield curve. But if we looked at APA, Atlas Arteria, Auckland Airport, all A's. They look Transurban as well. Yeah, they look pretty well priced, don't they?
I think so. I mean, they probably look fairly priced, Jez, versus the current interest rate, but they're probably trading at quite a slim margin. We know that although the cost of debt has risen for these assets or businesses, so has the revenues because their tolls, etc., are linked to inflation. So Atlas has reported this morning, I think, a really good result. And to give you an idea, that's on a 7% plus yield that's growing. And we did see some good inflation numbers this week. So potentially we might get a cut a bit earlier than expected here if that continues. So that'd be a driver for these stocks, which have been out of favour.
They have been, strange. They go in and out of favour. It may not necessarily, but you want to buy these things when they're out of favour. That's a really important thing. Something that's become in favour to foreign buyers is our building material space. CSR, Boral, Adelaide Bry was it called? It used to be Adelaide Brighton Cement. Amazing that in such a quick space of time, 3 are potentially going to go from the boards.
And this has really caught my attention because, again, like with Altium, all 3 are all cash bids. So fundies are going to be left with a lot of cash that they need to reinvest. They'll typically want to maintain some exposure to this sector. But the interesting thing for me is these are all trade buyers. It's not PE money or anything like that. The 7 is buying Boral, a big French building company.
It's I mean, you're right, injection back into the market and that money will find a place somewhere. There aren't many places. I mean, the building material space used to be massive in numbers of stock. It's really condensed down. There's an obvious name that could be
we like here. Which is Brickworks. And, I've been listening to, and we've been listening to I underappreciated, I think, how big a deal that Sol Pat's takeover of Milton was. And so the Sol Pat's business to me is humming. And the Brickworks side of the business, Goodman Group nearly hit $30 today.
Amazing,
So they've got the big tie-up
signal
with
to
them.
Brickies, isn't it?
And then you've got the building products division of Brickworks.
And that Brendan O'Day podcast, just amazing how that's just a cash war chest for them to go and do what they need to do with the Milton stock, which is incredible. So
it's that argument of permanent capital. Rob, we know, has gone to the Berkshire meeting, Rob Milner, every year for decades, and I think he's really following quite a similar strategy.
And the last decade's been a massive change for them, and they're looking more like Berkshire, quite honestly.
Completely.
Now, talking states, just foreshadowing as we jump off this video, you've got a trip. You're going to Austin, Texas for the South by Southwest conference, which will be amazing about a number of things, tech-related, AI, any thoughts? We're looking forward to your insights about that. So we'll maybe do a video when we get back. So I'm going with Aaron, and NetWealth's taking us, which they've put together a pretty incredible schedule for us. But I think it's been 5 years since we've been to America, and it's to get a bit of a pulse on what's going on in the country. But hearing from
there's people from all over the world being flown in to talk about, and I think AI is going to be a big talking
Massive,
point.
yeah.
What's happening in their industries, what's changing, and to try and drive some ideas that we can then use in our business for clients. So, that's exciting,
Yeah.
and also just good. I mean, probably the best idea I think we had the last 5 years was buying big tech in
Totally.
the US, and that really spawned out of the last trip that we
No
did.
question.
So
Yeah.
let's hope we can get something out of this.
No,
one.
looking forward to that. So look forward to those insights when
Yep.
you're back, and we'll be bringing you another one of these insights in March.